I would now like to introduce today's presenters. Prashray Kala is a partner and member of the global sourcing team. He assists clients on topics related to location optimization, enabling talent models for digital initiatives, increasing inclusivity and diversity in enterprises, and quantification of business impact, and benchmarking of global delivery models. Raghav Agarwal is a practice director and member of the global sourcing team. In this role, he assists enterprises and providers on topics related to global sourcing strategy, location selection decisions, talent model redesign, portfolio optimization, mergers and acquisitions, and go-to-market strategy. Ravneet Kaur is a senior analyst and member of the global sourcing team. In this role, she assists providers with location optimization, workforce strategy, benchmarking exercises, and captive management. And with that, I'd like to turn things over to Prashray.
Thanks, Trey. Hi, everyone, and welcome to today's webinar. As we come to the end of the first quarter of the calendar year 2023, in today's webinar, we will focus on two pertinent themes. The first being the health and performance of the global services industry. We will look at how the industry performed in 2022. And more importantly, then we will talk about what are our expectations of industry health in 2023, especially given the overhanging clouds of macroeconomic uncertainty. The second theme for today's webinar will be the key trends which are affecting the global services market. In this, we will talk about 5 key areas. One is offshoring. The second is, what are the locations globally which companies are choosing to set up their delivery centers in? Third being the balance between outsourcing and in-house delivery and how this is changing. Fourth being the changing talent, demand, and supply dynamics and how it has changed over the last few months. And the last theme for today would be ESG. Now, with that context, we will start talking about the overall health of the industry. And the easiest metrics to look at for that become revenue and headcount. Now, we define global services as a combination of both third-party outsourcing as well as in-house centers. And the last 2 years have been phenomenal in terms of growth. Now, granted that 2020 was a year which was significantly impacted by the pandemic, but 2021 saw 15% growth in revenue. 2022, that double-digit growth still continued. In fact, revenue grew about 12%. The overall headcount for global services last year grew at about 8%. Now, these were 2 high growth years which we've seen in the recent past. In fact, this kind of growth is something which we had not seen for the last 8 to 10 years, right? So industry is definitely having a very high period of growth, which was evidenced in the last few months. On the next page, we will look at a few other metrics which we use to track the overall health of the industry. One of them is number of new center setups. Essentially, we are trying to assess how many new service delivery centers are being set up separately by providers on the left-hand side, and then in-house delivery centers, or more the GBS model on the right-hand side. What you would notice is a tremendous spike, which we saw in 2022. Now, yes, 2020 was a low year. Start of 2021 was also a bit slow for new center growth. And a lot of this was impacted by the travel restrictions given the pandemic. But then things boomeranged back in 2022. Providers set up over 140 centers. On the in-house side, it was over 250 centers, new delivery centers being set up in the year. And a lot of this growth was a combination of digital as well as traditional services, right? On the next page, what we'll assess is more dimensions of what was the nature of this growth. For this, we will focus mostly on the outsourcing deals, and we will look at 3 elements. The first element being deal size. which is the total contract value. The second element being, where did these deals originate from? What were the headquarters of the buyers? And third being the industry flavor, which we are seeing in the outsourcing deals. Now, if we look at deal size, which is the first chart on the left-hand side, what is clearly evident is that small deals, the share of small deals in the overall portfolio is decreasing. Mid and large size deals are have been significantly increasing over the last 2 years. So definitely more TCV, which we are seeing in deals. And a lot of this is driven by new contracts, new push to outsource, new push to save costs, as well as some degree of consolidation within existing contracts. If we look at where did these deals originate from? Now, North America remains the primary geography, right? It accounts for over a third of the industry. But important to note, if you see the rest of world component, that's been one share, and this includes Asia Pacific, Middle East, Africa, Latin America, deals which are originating and the buyers are headquartered in these geographies. That share has been steadily increasing over the last few years. In fact, that's one area where we see now providers start to put a bit more focus on as they look at new avenues of growth. The third aspect which we'll see is what were the industry verticals which were driving this growth? Now, if you look at banking and financial services and insurance at the bottom of that chart, that's clearly been an area where the number of outsourcing deals has been decreasing significantly over the last few years. From 2020, where this was over 20%, last year it was just 15%. So definitely one area where the number of outsourcing deals is decreasing. Two areas where it has been increasing steadily has been government or public sector and the technology and communication sector. That's one sector where focus on outsourcing has increased significantly in the last 2 years. Manufacturing was one segment which had dipped in 2020, given it was the sector which was impacted most by the pandemic, but that has since recovered and is gaining back share of about over 12% of the overall outsourcing deals. Okay, so this is what we see overall from the health of the industry. It's a fair share of distribution across buyer geographies. Definitely positive signs being seen because it's more mid and large size deals which are being signed on by buyers, right? And more a democratic spread across industry verticals as well. If you move to the next page now, and that's where we would also now choose to focus on the next segment which we have, which is really the business outlook for 2023. I would invite the participants, the attendees of today's webinars, to share their own business outlook for 2023. This becomes very important because there is macroeconomic uncertainty. Companies are reevaluating how much should they expand for global services as well, right? And of course, interest rates are rising, GDP increases are not happening that significantly. Sentiment indices for slowdown, they are at an all-time high. So, that's the kind of input we would want from today's participants. I would encourage you to choose one of the responses options which are visible on your screen.
Yeah, and Prati, while we start getting responses, it's actually quite interesting that you mentioned we witnessed growth across most of the metrics that we track from a global services standpoint, be it center setup activity or the increase in deal sizes. However, there is no shying away from the fact that there are certain visible concerns in the market as well. Now, before dwelling a little bit deeper on that aspect, I see that we have started getting responses and there are some clear winners. It seems that most of the participants have a fair bit of optimism and expect a moderate growth in the market, which constitutes around 60% of the audience here. We also have a sheer bit of audience which expects a slight decline or a nearly flat growth in 2023, which constitutes around 30% or 30-35% of the audience here. Okay, if we move on, it's actually interesting to see the opinions of audience here, which actually resonates with some of the surveys that we did with the broader market as well. let me actually unpack this a bit further as we move on to the next slide, and wherein we discuss a similar survey that we did with more than 300 enterprises and provider leaders to understand the market sentiment around this growth. And what we witness is, again, resonating around slightly subdued growth or moderate growth in 2023 compared to the past 2 to 3 years. Now, the reason behind this is primarily not only the economic uncertainties that we are facing, so be it in terms of the rising inflation or the interest rate hikes, but also in terms of some of the concerns relating to the slowing demand, slowing consumer demand, or the changing market conditions in terms of margin pressures, some of the talent layoffs that we are witnessing as well. Now, while it seemed that the industry is not following in a similar growth trajectory as what we witnessed over the past 2 years, the growth is still higher than what we witnessed in the pre-pandemic era. And there are multiple factors, fundamental factors that are driving this growth. So one is on the lines of the sustainable cost arbitrage that we still get from offshoring, nearshoring ITBP services, or the changing nature of demand of services, which is an increase in digitalization, again, leading to an increase in the growth of the global services industry. An interesting trend here is that on the talent market situation, and I think we'll discuss a bit more detail in this topic in the couple of subsequent slides, but quickly touching on that aspect is how this situation is very different from what we have witnessed, say, in the past 2008 crisis or in some of the other slowdowns, is that for the first time ever, the demand for talent is outstripping the supply, especially when it comes to North America and Western European countries, which is further substantiating the case for growth of global services industry.
Yeah, and Raghav, it's quite interesting, right? I mean, at one end, we are talking about how there is macroeconomic uncertainty. There may be slowdown in some of the overall macroeconomic indicators, right? But at the same time, we are still saying that talent demand supply has not really solved for itself, right? In fact, if you see unemployment figures in the US, they're at decades low still. So I know a bit of mixed messages which come out because typically you would expect unemployment to rise, but then I think, as you had mentioned earlier, right, these macroeconomic situations are very different compared to what we had observed in the past.
Yes, exactly, Prashant. And in fact, to peel the onion further, our next section focuses on some of these growth factors as well as the trend that will shape the global services industry in 2023. So if we move on to the next slide, we'll witness that we will touch upon aspects such as the location strategies that are changing in the current environment, the shoring strategies that are changing, as well as the workforce and sourcing strategies of the organization. So starting from the very first trend, which is on offshoring and how that is changing in the current scenario. In conversations with many of our clients, we keep hearing how offshoring can be an effective tool to reduce cost or to increase operational efficiency. In fact, in the past 2 years, we have witnessed an increase in the share of offshore, and it now constitutes around 66 to 67% of the total center setups, with the remaining being in onshore geographies. To further test the hypothesis whether this trend is expected to continue in 2023, we did a key issues survey, as you can see on the slide, wherein we tried to first understand the market sentiment towards some of the challenges that organizations are facing and how are they trying to solve for it. As we can see, talent still is amongst the top 3 concerns. However, price or cost pressures has jumped to actually being the top challenge that organizations expect to witness in 2023, which in turn means that organizations are now looking for ways to reduce cost or solve for these margin pressures, and that is why it becomes the #1 priority for organizations. And the significant cost arbitrage that we witness from offshore destinations is one of the possible solutions that organizations are leveraging. Now, if we move on to the next slide, we'll see that both providers and enterprises actually expect the offshoring headcount to grow substantially higher as compared to what they would expect to witness in nearshore and onshore geographies. While there is growth expected when it comes to nearshore and onshore geographies, and it would be primarily driven by considerations around niche skills, language skill availability, and so on. But all in all, offshoring is here to stay, and in fact, will continue to drive the growth of the global services industry. Now, we've talked about cost, but there are other factors that are pushing the pendulum in favor of offshoring, as we see on the next slide. First, Prasha, as we touched upon earlier, you were talking about talent shortage and that leading to an increase in offshoring. Now, what do we mean by that? Essentially, we also see a war of talent going in offshore geographies such as India, Philippines, Central Eastern Europe, but the situation is not as severe as compared to some of the onshore geographies such as North America or Western Europe, given various reasons, be it the aging population that they have or the changing talent preferences. Now, to solve for this shortage, there are multiple solutions that organizations can deploy, be it the upskilling initiatives, better deployment of hybrid, etc. But one of the fundamental factors that organizations are deploying to reduce costs and to tap into a larger talent pool across geographies is to leverage the offshoring route. Another interesting trend that we keep hearing from our clients is whether this cost arbitrage between offshore and onshore geographies is sustainable. And the answer to that is yes. In fact, when we look at the business case for offshoring, it suggests that even in the next 10 years, the cost arbitrage would remain strong and sustainable. So yes, there is wage inflation, but other levers such as pyramid optimization helps in maintaining and managing the cost. To shed some more light on it, if you look at geographies such as India and Philippines, they would continue to provide greater than 70 to 80% cost arbitrage, even in the next 10 years, in comparison to locations such as North America. When we look at Central Eastern Europe, countries such as Poland and Europe will have an arbitrage around 50 to 70%, even after including the foreign exchange impact. Now, we looked at a lot of positives that are pushing the case for offshoring. Ravneet, you've been supporting organizations in their shoring journey. And in your conversations with clients, what do you think are some of the challenges that organizations face when they're trying to offshore certain processes or roles?
Thank you, Raghav. I do agree with you that offshoring is offering multiple advantages. And given the current macroeconomic and business environment, it seems to be an even more viable option. However, as we hear from our clients, understand from the industry, there are multiple parameters beyond the cost and talent opportunities that do play a pivotal role in deciding this shoring mix. So just to point out a few, services or processes that require in-person interactions with stakeholders might be challenging to offshore, especially when we look at getting stakeholder buy-ins and other things. It is not very convenient to shift these services or processes to offshores. Further, from what we understand, offshore regions are predominantly focused on English language delivery. So for processes and services that require, skills beyond the English language, the availability of the right talent mix is limited. And so nearshore locations like Central Europe or LATAM make a better choice. And lastly, and perhaps the most important one, is the growing stringency on data protection measures, like the recent implementation of GDPR in Europe, which may create hindrances in offshoring for enterprises that plan to adhere to such regulations. So yes, Raghav, to answer your question, there are challenges to offshoring, but what we understand that on an overall level, the benefits of offshoring tend to outweigh these concerns. Okay, moving on to the next trend. Another interesting thing that we are witnessing is the evolving nature of tier 2 and 3 cities across onshore, nearshore, and offshore geographies. These cities are now becoming the next hotbeds for growth, driven by the need to access a much wider talent pool, as well as, further reduction in costs. Now, before we divulge further into this trend, we would like to understand the stance of today's audience when it comes to leveraging these cities. I will request you all to please choose the most applicable option from the poll question that has popped up on your screens. We'll keep this poll open for the next 30 seconds to understand what is the view of today's audience when it comes to these locations.
And this is your current leverage of tier 2, 3 locations, right? So trying to understand what is the as is for now. And then, of course, we will talk about how we are seeing some changes, which we foresee in the next few quarters.
While the results are rolling in, if I reflect back on the last 2-3 years, we did see these cities being leveraged more extensively by both providers and enterprises. It will be intriguing to see, if the developments in the macroeconomic and business environment have in any way changed, what is the role of these cities in the location strategy. And I think we do have results with us. And if we can see, around 43% of our respondents, they do have some presence in tier 2-3 cities, and around 26% are extensively leveraging tier 2-3 cities. So it seems that tier 2-3 cities are the growing destinations of choice for the industry, which further reaffirms our understanding on the growing importance of these locations. If you move to the next slide, globally as well, we're witnessing multiple enterprises as well as providers investing in tier 2 and 3 cities for IT/BP service delivery. And this trend is not only restricted to your onshore locations like North America and Western Europe, where traditionally we have seen a much higher activity in tier 2 and 3 cities. In fact, in onshore and nearshore regions as well, we see a growing evidence of significant leveraging of these cities. Of the 400 odd centers that Preshray had mentioned that were set up in 2022, close to half of them were actually in tier 2-3 cities. For locations like Latin America, Middle East, and Africa and Asia Pacific, the center setup activity grew by more than 100% between 2021 and 2022. If we take the example of India only, more than 10 cities have emerged as strong contenders for expanding beyond the mega hubs in Bangalore, Hyderabad, Mumbai, and Delhi. If we move to the next slide, we see that beyond the talent advantages, substantial infrastructure development, the push from governments through incentives and tax benefits, and the widespread adoption of hybrid working, satellite office has put multiple cities on the global map for service delivery. In fact, over the last 3 years, the collective market share for tier 2 and 3 cities has almost doubled. Between 2019 and 22 itself, over 175 centers opened up in cities beyond the traditional tier 1 locations in US. Cities like Dallas, Atlanta, Phoenix, Houston are some of the top emerging locations which are offering a good 15 to 20% of cost savings over something like a New York. If we move a little east towards Europe, we see cities like Gdansk, Lodz in Poland, Cork in Ireland, and Timișoara in Romania, which are gaining prominence and garnering a lot of interest from the industry. Moving further east to Asia Pacific, India and Philippines continue to be the top destinations of choice for IT/BP service delivery. Within India, cities like Ahmedabad, Indore, Kochi are now being increasingly leveraged to support ADM and infra services. In the Philippines as well, while we understand a good 60% or more of the service delivery headcount is in Metro Manila, many other cities are rapidly emerging, driven by the improving infrastructure and talent availability. Just to name a few, cities like Iloilo, Davao, and Bacolod are being leveraged for contact centers, F&A, and procurement services as well.
Okay. Rodney, this is quite interesting. I think there are so many cities here which potentially many of the attendees would not even be aware about, right? And it does seem like there is a fair bit of market activities. I do see many big provider names. I do see some big tech names. I had a question though. How prevalent is this for in-house centers as well? So, service providers, of course, they have a completely different scale at which they operate. They have different recruitment and training engines, right? But is tier 2, 3 as prevalent for the in-house or the GBS model as well?
I totally agree with you, Prashray, that, when we see a lot of service providers, given their aggressive hiring and workforce strategies, we see bigger service provider names on this screen. But on an equal level, we do see a lot of in-house delivery centers being set up in tier 2 and 3 cities, especially as we see enterprises getting comfortable in a tier 1 location. They are moving to tier 2 and 3 cities within that country. And a lot of big tech names as well are moving to these tier 2 and 3 cities. In fact, within US as well, beyond the tier 2 and 3 cities, we're seeing movements to tier 4 and 5 cities as well. So yes, if we move forward, we do expect this share of tier 2, 3 cities to continue to increase steadily, driven by multiple reasons. And the first and foremost of these is cost savings. Now, recession or no recession, cost savings continue to be an important driver. Setting up your centers in these cities provide huge cost advantages, as the cost of operations in these locations is a good, say, 5 to 15% lesser, at least at the lowest. In fact, organizations are also moving to these locations to access the untapped talent pool. Like Raghav mentioned, like you mentioned, Prashray, talent continues to be a concern for this industry. And we are seeing a lot of organizations moving to these tier 2 and 3 locations to access this untapped talent. Now, I agree these locations will have a relatively lower talent scalability potential, but they still have a sizable talent pool, which has a much higher propensity for these service jobs. The third reason that I can think of is that tier 2, 3 locations also experience lower attrition than tier 1 cities, which not only results in better service delivery, but also lower hiring and training costs. If I take an example, say in a tier 1 city in India for an IT service delivery, attrition rates are around 22 to 26%. But if we move the same thing to a tier 2 location, this comes down to a 14 or an 18%. So yes, on the talent end, not only do we get a better talent pool and a much larger talent pool, there is much lower attrition as well. The fourth reason that I can think of is that these locations allow opportunities to minimize concentration risks. They allow you to capitalize on the city's advantages, as well as ensure business continuity. So with the high talent demand supply mismatch that is prevalent in tier 1 cities now, companies are facing a high level of competition. So right now with the, a much smaller proportion of firms in these tier 2, 3 cities, there is much lower competition for talent as well as other resources. Now, lastly, and I believe this is one of the key reasons we are seeing a lot of firms leveraging tier 2 and 3 cities, and that is employer preference. With the change in working models with COVID, we see a lot of employees have moved to their hometowns with this hybrid working structures. And now there is a growing preference amongst these employees to have offices closer to their hometowns. We're seeing instances of multiple providers setting up spoke and satellite hubs in these cities, citing this very reason. So if I put all of this in a nutshell, we believe the advantages on workforce, cost, as well as market competition are going to be big reasons that will continue to push enterprises as well as providers towards these locations, especially as the key global hubs start to saturate and the working models continue to evolve. Now, before we move on to the next trend, we do have some complementary thought leadership for our audience today, like mentioned at the start of the session. For those of you who are looking to read further into the trends that are shaping up the location strategy, we do have a complimentary report for you. If you would like to request this, please click on the link in the post-webinar survey that comes up. We will also be sharing it over an email with the link to the report shortly after this webinar with you. Okay, so moving ahead, I think we understood what is happening on the shoring end, what is happening on the locations end. Raghav, can you take us through what is happening on the sourcing end?
Sure, Avneet. Okay, so when it comes to sourcing, the sourcing leaders are actually closely watching this space, and they're not looking at in-house versus outsourcing in silos anymore, but they're actually firing on both the fronts to have an increased global services usage. Now, we've tried to depict this through a 2x2 matrix on the next slide, wherein we show what a typical market scenario looks like. So let me just explain this a little bit. In a typical scenario, what we witness is that organizations that have a stronger in-house delivery team, they tend to leverage the GBS model more strategically. Or on the other hand, if they are facing challenges in terms of their in-house delivery, they tend to leverage providers a bit more. However, in reality, and what is different this time is that the sourcing leaders are actually going all in when it comes to exploring opportunities, be it in-house or be it with providers. Essentially, they're looking at both the fronts from more of a partnership play, as if each is enabling the other, given the ultimate goal is to A, expand the capabilities, B, acquire the talent, and C, frankly, just to grow the overall business operations. Now, they are trying to achieve this through either strategic alliances with providers or through growing in-house centers to get the best of both worlds. Now, moving on, let's just unpack this a bit more and double click on some of these parameters. As I was mentioning, there are a set of enterprises who are leveraging the GBS model more strategically. Now, it depends on the kind of heat that they are facing on financial and business pressures. So if there are a certain set of organizations that have high financial or business pressures, they tend to leverage two major routes, which is A, insourcing some of the or keeping some of the core competencies in-house, as well as at the same time looking at vendor consolidation opportunities. Now, we did a key issues survey, and one of the facts that come out of it was that close to 1/3 of enterprises are actually looking to consolidate or rationalize their provider mix. On the other hand of the spectrum, there are also a set of enterprises who are facing relatively lower pressure and they continue to expand into GBS, looking to grow them into more strategic partners, which is accompanied by an elevation in the GBS role by building global ownership and change management capabilities.
Okay. Raghav, this is quite interesting. I know you've been saying that enterprises are growing both outsourcing as well as the GBS model, which is the in-house delivery model. But just taking back to what we were earlier discussing on the macroeconomic conditions, right? And of course, there is cost pressure, there is investment pressure as well for some of these new initiatives. So in such times, let's say if enterprises who are looking to set up new in-house centers or set up a new in-house center in a new country, right? Or maybe first-time entrants, are they easily able to find funding for such initiatives as well, or are they being cautious about it? And is this impacting, let's say, the in-house versus outsourcing balance as we were talking about?
Yeah, and that's a great question, actually, Prashar. We've been hearing this from many of our clients as well. And the answer to that is that we are seeing an increase in setups. Now, organizations are trying to use more creative ways, and that is something that we'll talk on the next slide as well. But they're looking for creative ways in terms of leveraging the providers as well. So using opportunities such as build, operate, transfer model, or a joint venture or an assisted captive. As well as at the same time, there are a certain set of enterprises who are continuing to do it on their own end. So a mix of both, and we're seeing growth across both the parameters, but it depends upon the kind of pressures that the organization is facing. Okay, so just to touch upon what Prashar mentioned as well, and we'll look at this in the next slide, wherein we talk that at the same time, there are certain set of enterprises who continue to leverage providers. Now, there are two primary reasons for it. One, enterprises who are looking for ways to reduce either cost or to accelerate their digital transformation agenda or to share risk they are leveraging providers for either outsourcing opportunities. Now, some of the opportunities that we have seen a spike in recently includes around functions such as infrastructure, data center, help desk, contact center services, as well as what we have seen is an increase in divesting the in-house delivery centers. In fact, what we will see is that the number of divestitures per year has increased to 2.5 to 3x compared to any given typical year. And this is somewhat similar to what we saw during the 2008 financial crisis. However, an interesting thing to note on this increase is that the desire to construct transactions like this is no longer a desperation move just to raise capital, but it is also more of a strategic lens that are coming in some of these deals. So enterprises are looking like, hey, we want to have an accelerated outsourcing play and an offshoring play. We have built some capability and we want to make sure we are capitalizing on the same. So the mindset is becoming more interesting in over the last few years, and we continue to have active conversations where GBS leaders as well as enterprises are thinking strategically on how to build this partnership. Now, Prasha, you also mentioned an increase, and we touched upon this aspect of how we are seeing a growth in some of the captive setup opportunities. And the reason behind it is this, one of the things that you mentioned is the enterprise's resistance towards the initial capital outlay that they have to make. And that is where service providers can help, as well as some of the challenges that an enterprise could face in terms of procuring talent in a new location. It also provides faster speed or faster access or speed to market from an enterprise lens. And from, if I look at it from a provider lens, it not only increases their book size, but it also provides them with a skilled talent. We are also seeing a transformation support that the enterprises are taking from the providers, be it in terms of process transformation, support on specific tools and technologies, as well as staff augmentation. Now, with that, this is broadly what we have covered on the sourcing front, we have covered on the location front, but any discussion would be sort of unclear if we don't talk about talent. Prasha, what do you feel? What are some of the recent trends that are going on in the talent market?
Sure. And talent was the hot topic for last year, right? I mean, so many engagements which we did with clients as clients were struggling to find talent, and everybody was desperate, especially on the tech talent side, right? Will they be able to grow? Will they be able to scale up these teams? Of course, we are seeing an impact of that in some of the latest headlines, which we see for the last few months. Some companies did hire in excess. Many of the large companies, tech companies especially, hired at least 5 to 12% of headcount in excess, and then the process of reducing their overall employee headcount, right? So yes, last year was absolutely a mad scramble for talent, right? As we see this year and as we see as of today, yes, the demand for talent is reducing, but it is still not ideal. It is still much more than what it was 4 years, 5 years back. And it's the supply of talent, which is actually becoming a critical concern for companies, right? I think we talked about it earlier. We talked about changing demographics, changing, I would say, age groups and the percentage mix, which we see in North America, Europe. And second, and most importantly, it's also about changing preferences of some of these newer graduates, right? Of what kind of industry, what are the various work options available to them? Do they want to work full-time, part-time? A lot of online and internet-related service options available to them as well. So all in all, I would say the talent situation is much better than what it was last year, but it's definitely not solved for itself, right? So on this page, we are just comparing in the last 6 months, have we seen, what kind of improvements have we seen at various locations? So if you would see some of the general locations, whether that's US, Latin America, or the large offshoring destinations of India and Philippines, the talent situation has significantly improved. The demand supply gap has decreased in these locations, right? There are still some locations, Canada, Malaysia, few locations in Europe, where this is still quite a concern. But slowly, situation is improving, right? In fact, if you see on the next page, what we also talk about is how do we see this situation play out in the long term. So if you could move to the next page, please. What we observed actually was 5 phases of this entire talent situation, right? 2020, pandemic had just started. There was uncertainty. There were some job cuts. 2020, 2021. When you started 2021, there was still a hiring freeze, which was going in companies, right? They were still unsure on what kind of future workforce models they'll have, what need they'll have. But 2021, as soon as the Great Resignation picked up pace, we started seeing very high attrition. We started seeing very high wage inflation as well, as companies try to retain talent and attract new talent. This continued till 2022, easily till the first quarter of 2022, where these extremely high wage hikes were still very prevalent. But we started seeing some semblance of sanity creeping into the market from 2022 mid onwards, right? So some of those extremely high wage hikes reduced. In fact, now it's back to your 2019 levels. But still, in this current phase as well, there is still uncertainty. Yes, some companies are letting go of talent. There's a temporary relief in the demand, at least, which some of these large companies were driving. But if I ask my clients today, are they easily able to hire a cybersecurity engineer, a network architect? They're still saying it takes many months, right? Especially North America, still taking a lot of time. So there is still scarcity when it comes to high qualified talent. If you move on to the next page, and here is where we are taking a slightly more long-term view. So this is the demand supply gap, which we're seeing specifically for IT. We've called out a few specific functions and skills within IT, which we're assessing here, right? You would see that a talent demand supply gap is reducing year on year. In fact, for the next year and a half as well, it will keep on reducing, but it's not expected to dip below 2024, to dip below 10%, at least till the next year. So the demand supply gap still remains, especially when we talk about niche skills, but situation is slightly improving overall. I think we are coming off from this mega cycle of growth, which we see in tech. A lot of it was funded by the easy money available. A lot of it was funded by the boom, which we saw in tech usage. But yeah, somewhat of a semblance of balance, which we'll start seeing in the next 18 months, I would say. Okay, if you move on to the next page now. So this is another thing which our clients ask us, right? What should we do now on the talent side? So if you're not hiring as much as we were in the past, what do we do now? What should our focus on talent be? Across most clients, the focus is on the existing workforce. So yes, they are not focusing that much on hiring new workers, but most of the focus of the talent team is on the current existing workforce, whether that's upskilling and reskilling them. And this may be to build the newer complex skills. A lot of this is also to train the talent which was hired mostly remotely. And a lot of training investment is going in those areas as well. So upskilling, reskilling remains priority number one. Improving employee experiences remains a high priority as well. Many companies are struggling with this. They went ahead and announced aggressive plans of, hey, we'll be mostly remote, don't need to come to office. They've realized the differences which it has led to in productivity, employee engagement. They're trying to rectify that, calling people back to office. But at the same time, now they need to decide on what the employee value proposition is. How can they improve employee experiences? That remains a big focus area for our clients. We talked about cost savings being a number one priority for companies this year. And that's the reason why employee productivity is back in the focus, right? So how can you improve employee productivity? And the last lever on talent, which companies will be focusing on, is how do you change your talent engine to focus more on the long-term steady state pipeline building rather than on that short-term bump which was really the need of 2022. So all in all, there's a lot of investment which still needs to go on the talent side, right? Now, speaking of investments and moving from talent as well, our clients often ask us about ESG, and that will be the next topic which my colleague Ravneet focuses on. And Ravneet, let me straight on ask you that hard question, right? Especially in an investment constrained environment, clients often ask us this question: how much of a focus can they still afford to keep on ESG, right? So I'll hand it over to you. I know you've talked to many clients on this. Would be great to hear your insights.
Right. Thank you, Prashray. And I agree, when it comes to ESG and sustainability, the trend is what is going to happen now with, all the budget cuts and cost margin pressures that are coming in. So if we move to the next slide, we will be talking about what is happening on the sustainability end, especially given the macroeconomic environment and business environment right now. And if you see on the next slide, totally in line with what comes to our head, media headlines are painting this picture that, because of all the growing cost and price margin pressures, unsustainability is expected, the sustainability measures are expected to take a backseat. Not only are we looking at ESG budget cuts, but the massive layoffs are also expected to hit hard when it comes to diversity and the inclusion agenda. But you know what? On contrary to all of this, if we move to the next slide, our surveys and findings point in completely the opposite direction. Earlier this year, we did a quick poll to understand how enterprises are feeling about their sustainability initiatives amidst this uncertain macroeconomic and business environment. And the results were actually strongly in favor of sustainability continuing to be a focus area. If you look at the right side of this slide, we can see the responses to the quick poll. It can be clearly deciphered that the majority of the firms are actually looking to not make any change on their sustainability goals, or in fact, they're looking at increasing them, even if it's marginally. Now, for the, say, 17%, which are actually looking to decrease them marginally or significantly, there is an equal proportion of respondents who feel that they will significantly increase their efforts on the sustainability agenda. So what we can fairly conclude is that enterprises are now of the consensus that sustainability is not something that we try only in the good years, but it is something much more pervasive, and it is something that needs to be part of a solutions today so that the challenges of tomorrow can be overcome. On the provider side as well, we see sustainability is becoming an important aspect of the growth plans. Between 2021 and 2022, the publicly announced outsourcing deals that did have an ESG component grew by a strong 56%. In fact, if you look at the chart on the left-hand side of the slide, you will see providers are not only taking organic measures, but inorganic measures as well to build on their ESG capabilities. The share of ESG-focused M&A activity has almost become 4 times, from a 3 to 11% in just 1 year. And for organic measures like new offerings, as well as inorganic measures like alliances, we do see an increase. So to answer your question, Prashri, if I put the two sides of the story together of what exactly is happening and is sustainability still a focus area, what we understand is that these news headlines are just quoting some of the knee-jerk reactions to the evolving environment. But at a much wider level, both enterprises and providers feel that sustainability initiatives do make a fundamental business sense. And just because there are short-term and medium-term uncertainties, they need not be sidelined. If you look at the next slide, it will become evident that sustainability has moved on from being just a good add-on to being a key driver of business success and managing stakeholder expectations. Now, these could be internal stakeholders like your employees, or external stakeholders like customers and investors. All these stakeholders are looking intently on what sustainability means for a firm. So if I sum it all up, while there are concerns over continuing with sustainability, with uncertainties mounting, and that is truly understandable, but putting a pause on them may only provide a temporary relief. Keeping in mind the long-term growth and vision in mind, it is imperative that we continue to focus on sustainability initiatives and, more importantly, build them into the very core of our business.
Thank you, Ravneet. That was wonderful to hear insights on ESG. We are now moving to the end of the webinar. So just recapping some of the key messages that we've talked about. If you could move to the next page, please. We talked about five key themes, right? Before that, we talked about industry health. So from an industry health point of view, we are still seeing some growth in the industry. Yes, it's not as high as it was in the last couple of years, but definitely the sentiment is positive. Key trends which we expect to shape the industry further: offshoring, especially in locations like Philippines and India, will continue to grow and will be a driver of the industry. Tier 2, 3 locations, again, both in the offshoring countries, which I described, as well as in Europe and North America, will continue to increase in the portfolio of companies. Third, both in-house and outsourcing models increasing, right? So companies are leveraging both of the models for growth. They're being very strategic and programmatic about which model makes more sense in what scenario. But definitely, as we saw from increasing headcount, increasing center setup, both of these models are increasing rapidly. Talent demand supply, yes, easing a bit, but imbalances remain. And last, as we heard about sustainability, right, which still continues to be an area of focus. These were the key messages that we talked about in the webinar today. I know many of you will have questions regarding this. Some of you have already shared your questions on chat with us as well. And if you could move to the next page, please. I will invite more questions from the participants, from the attendees of today's webinar as well. We'll try to answer as many questions over the course of the next 7 minutes. But in case there are any unanswered questions, do reach out to your points of contact at Everest Group, the client relationship managers, and they will definitely channel it to us and we'll respond to you. Okay, just talking about some of the questions which we've been seeing, right? Okay, one very clear theme which I'm seeing in many questions is around macroeconomic uncertainty. People are quoting some of the recent banking disasters as well, Silicon Valley Bank, a few other things. So this question again comes back to, has the macroeconomic situation worsened so much that we need to start rethinking on our investments? So Raghav, maybe not talking as much about the macroeconomic situation, but the impact on global services industry, right? For providers, for in-house centers, for enterprises, you know, does macroeconomic situation changes, should they be as big a concern as what some of the latest news tends to suggest?
So thanks, Prashay. And this is a very relevant question, and in today's context, especially. As we discussed, when we see the growth, there is some slowdown, and it's actually indicating more towards a normalization. Given in the past 2 years, we witnessed significantly high growth. So yes, there is a slowdown, but I would like to call out that it is not as alarming as it was compared to, say, the 2008 financial crisis. Now, reasons behind it is, say, for instance, you talked about some of the uncertainties that are going on in the banking space. So Silicon Valley Bank and some of the other developments that are taking place as well. Now, while this PFS is a major contributor when we look at it from a provider lens, however, it does not seem to be an existential type of crisis. So while one sector may show some slowdown, other sectors are growing. And when you were talking initially about the industries, what we were also witnessing was a slowdown in the BFS segment over the past 2 to 3 years. So from a 21 coming down to a 15%. So there were certain signs from the past few years as well. Now, in terms of the direct impact, there would be slowdown in terms of new deals, but it also leads to new opportunities. So when I see opportunities, it could be in the M&A space, like we were talking, an increase in captive carve-out, divestment opportunities, as well as transformation opportunities that are coming towards providers. So all in all, we are seeing both the kinds of situations that are playing out. There are opportunities. However, at the same time, there is indication towards more of a normalization of growth.
Okay, great. Second question. So multiple people are also asking us, how are we seeing employees handle the request to return to office? Ravneet, I'll pose this question to you. There are companies which are changing their strategies on calling back employees. How are companies dealing with it? What's the long-term stance for hybrid?
Thank you, Prashri. And I do understand this is one burning question in the mind of everyone, that what is going to happen with return to office. And honestly, when it comes to the global sourcing industry right now, global services industry right now, we are witnessing a lot of mixed trends when it comes to return to offices. We are seeing some companies, especially providers and big tech companies, are asking their employees to come back to office, citing one of the key reasons as the need to maintain company culture. And like we saw on the talent aspect as well, like you were discussing, that this is a concern. And that is one reason firms are asking people to come back. But that is not the entire majority. There are also a lot of instances where we're seeing that companies are looking to continue working with remote working. And this is majorly to cater to employee preferences. In fact, like we'd mentioned, they are setting up satellite hubs, or they're setting up spoke models in these tier 2-3 cities so that they can cater to the employee preferences and have offices set up near the hometowns of employees. Another thing that is playing a decisive role is on the kind of processes or jobs one is involved with. Now, roles that are involving a greater level of in-person interaction with stakeholders, or roles that we see that have say higher which are dealing with highly sensitive data, have witnessed employees returning back to office full time. But if we put together the general sentiment, I believe hybrid working setup will be the trend that will go on, and we will see a good mix of employees coming in, say 2-3 days a week, which gives a balance of the employee preferences as well as the needs of the employers.
Got it. Thank you. We just have 1 minute left. Raghav, I'll squeeze one last question to you. Wage inflation. What are we seeing happening over there?
Okay, great. I think
15 seconds. 15 seconds. Yeah.
Okay, so demand supply gap was there last year, so there was a higher premium. Now we see certain normalization happening in the short to medium term. We will still witness a talent demand supply gap. And basically, there are two factors to be kept in mind. Inflation is increasing and customer demand is witnessing a slowdown. So organizations are taking a cautious approach.
Got it. Thank you so much. Thanks, Ravneet. Thanks, Raghav, for sharing the wonderful insights, both from an Everest Group analysis as well as what you've been hearing from so many clients. Thank you. This was really great to hear and very informative. For the attendees of today's webinar, there is more content on Everest Group blogs. There is more content on our research reports, which are available on our website as well. You would see a variety of topics across talent, locations, outsourcing, in-house, as well as state of market, as well as reports specific to particular industries. Would encourage you to explore the very large repository of research which we have, right? And thank you again, everyone, for attending today's webinar.